So what I want to do is follow up on what Professor Rose Ackerman just talked to us about by looking at a sub-issue within the broader category of illicit flows, right? $8.5 trillion, representing more than 6% of all global wealth, is managed through offshore accounts. Much of the income that's generated by those accounts, and some of the principal, importantly, that's deposited into those accounts, evades tax. Now, when I say an offshore account, let's be clear. I mean an account in a financial institution outside the taxpayer's own country of residence, whether that's a beautiful Caribbean island or Switzerland, a place that's just as beautiful but mountainous and landlocked, or Miami. In other words, onshore and offshore doesn't have anything to do with are you at sea, okay? The key thing to keep in mind is that the extent to which assets from a country are managed offshore is not uniformly distributed around the world. So less than 2% of North American private wealth is held through offshore accounts, okay? That's despite US concerns about offshore tax evasion. Meanwhile, more than 8% of European wealth, about 30% of all Latin American private wealth, and upwards of 40% of African private wealth is managed offshore, right? And the data is unreliable, but the OECD has suggested that, offshore tax evasion costs the emerging and developing economies amounts that begin to approach the amount of total official development assistance, which is like $120 billion per year. So that just gives you magnitudes, right? Beginning in 2008, however, some well-publicized cross-border tax evasion scandals involving prominent financial institutions focused the highest level political attention on offshore tax evasion by Americans and Europeans. That is to say, people from those places that in some sense are least impacted by offshore tax evasion, okay? But also are most able to do something about it. And the stories really do read like a thriller. They are as sexy as tax gets, right? Bankers are like smuggling diamonds across borders in toothpaste tubes. Governments are buying, illegally stolen lists of clients that are engaging in tax evasion from disgruntled bankers and giving them brand new identities. It's great stuff, right? Like a novel. But the scandals implied billions of dollars of revenue losses for some of the world's largest developed economies. And coming during the financial crisis, they managed to turn offshore tax evasion, which until that point had really been a tax administrator's concern. Like, you guys don't want to talk about the commissioner of the IRS because you're not tax lawyers, so you don't get excited. You say, ooh, boring. But all of a sudden, finance ministers and presidents of the world's largest economies were declaring, things like the era of banking secrecy is over, right? And a multi-pronged response followed that included unilateral actions by a variety of governments, multilateral efforts to improve tax administrative cooperation, including new automatic information exchange proposals from both the OECD and the European Commission, bilateral arrangements between large asset management jurisdictions, places like Liechtenstein and Switzerland, and large financial centers, especially like a very important anonymous withholding deal between Switzerland and the UK that I'll come back to. And then, most importantly, US enactment of legislation known as FATCA that's already been mentioned today. All these responses have one thing in common, which is that they require that financial institutions act as tax agents cross-border, meaning that they act to help governments other than the jurisdiction where they are located to collect tax. Just as financial institutions have acted domestically to help tax authorities collect tax on capital income for decades. So think about the 1099 the IRS sends you every year, right, to tell you how much interest you earned and therefore how much tax you owe to Uncle Sam. In just 5 short years, we've moved from a world where no one thought that financial institutions should be tax agents like that, cross-border, right, to a world where almost all key stakeholders, so both governments and financial institutions, are arguing about how financial institutions should do that and for what countries, rather than whether. And that represents, and we should recognize it, an enormous and important change for the international tax system, like a new emerging regime. FATCA had the single biggest impact of any development in that global change. FATCA is a very complicated piece of legislation, but it can be summarized as the US telling foreign financial institutions to identify US, and importantly only US, account holders through detailed diligence procedures of their accounts, and to report directly and automatically to the Internal Revenue Service about account balances and interest, dividend, and other income earned through those accounts every year. Or else, with the or else being punitive withholding taxes that as a practical matter would mean loss of access to US financial markets for any non-complying institution. The thing is, these reporting requirements apply regardless of restrictions placed on a financial institution under their domestic law in the country where they actually operate. And under most countries' domestic law, almost all countries' domestic law, revealing bank information of a client to a foreign sovereign, without the client's permission is flat out illegal, okay? So FATCA really put non-US financial institutions between a rock and a hard place. It said, do something that is illegal for you to do, or else Uncle Sam whacks you, okay? That is US law, and it comes into force next year. And it has been US law for a few years now. Counterintuitively, as a result of that law being enacted in 2010, foreign financial institutions were forced into being the United States government's best lobbyists for FATCA, okay? On the one hand, they ran around the United States and lobbied for FATCA repeal. But it became pretty clear that wasn't going to happen, okay? It's hard to lobby against a law about addressing offshore tax evasion, okay? And so what do? They lobbied foreign sovereigns even harder to come up with a solution to this problem, right? To solve the conflict of law problem. And then after a year or so, after the financial institutions had softened up their local governments, the US showed up with its new idea, okay, about intergovernmental agreements by which information on US account holders would pass through foreign tax administrations to the Internal Revenue Service under treaty-blessed, bilaterally agreed information exchange channels, thereby removing, magically, the conflict of law problem. Those agreements were eventually entered into, and a number of countries that entered these agreements with the United States became keenly aware that they shockingly wanted the same information on their residents that the US wanted on its citizens, and that meant not only that they wanted reciprocity from the United States, but that they wanted information from other countries too. The 5 largest European countries, so the UK, Germany, France, Spain, and Italy, who were the first to negotiate on FATCA with the US, were particularly interested and came up with the idea to start a FATCA-style multilateral pilot project among themselves, and then they began to discuss expanding that project into a multilateral system. But that conversation, unlike FATCA, is still in its childhood. And so the key question today is the one Thomas raised at the start of the session. It is a question about how broadly available automatic information reporting will become in terms of which countries besides the United States will eventually receive benefits from FATCA and its progeny. And it's clear FATCA will have at least some progeny. Things like the UK rules that are forcing UK-dependent territories, so think every Caribbean island you've ever heard of, to report on UK residents' accounts to Her Majesty's Revenue and Customs under FATCA-style principles. That, at least, is a done deal, okay? But tax administrations in emerging economies have a huge stake in ensuring that whatever benefits the large developed economies obtain in the form of automatic information exchange for tax purposes is available for them too. A uniform automatic information reporting system, one that works for everyone or for most countries, could raise revenue for countries dealing with enormous inequalities that we've talked about. It could allow capital income taxation to play an expressive role in building liberal democracies that are accepted as legitimate by their peoples, by the vast majority of citizens who want to see the wealthy in their countries abide by the law, right? And it can encourage taxpayers who are paying those taxes on capital income to engage more intensively with the polity and demand governmental accountability with respect to those taxes they have paid, which can, at least in principle, contribute substantially to reducing corruption. So that's why you want automatic information exchange. The problem is developing and emerging countries aren't like the United States. They can't just demand information, choose a unilateral coercive sanction to make financial institutions comply, and expect to see some benefit. For them, only a truly multilateral solution will do. So as a result, the prospect of countries like the Philippines or South Africa or Brazil benefiting from automatic information exchange turns heavily on the question of whether any new regime provides for uniform or for fragmented compliance by big multinational financial institutions, meaning compliance under one set of rules for all governments as opposed to under various differing standards, technically differing standards, for any government or group of governments who have the leverage to demand that from a financial institution. The primary reason for this is totally pragmatic and focused on the processes of the private sector. If a standardized compliance regime for offshore accounts emerged, the large institutions would implement that regime in a standardized way as part of their account opening procedures across jurisdictional boundaries. And they would have incentives to undertake firm-wide IT projects aimed at enabling information reporting on all accounts the financial institution manages, regardless of the country of residence of the account holder, just categorizing everyone by country of residence once, solely out of cost consciousness, right? Just being driven to reduce costs pushes them in that direction. But if there are multiple rules, then the incentive is to do only what has to be done to comply with each individual set of rules that the few jurisdictions that can successfully force rules upon financial institutions for themselves may create, with other countries left in the cold, right? And right now, we're not necessarily headed towards a uniform system. Okay, so one immediate problem, for example, is that the European Commission has been resisting the technical detail, although not the political intent, of the embryonic FATCA-style global solution that has now come to be represented in OECD documents. They are promoting instead an alternative set of rules based on a European legal instrument called the Savings Directive, which in my view is inferior to the FATCA-style solution. Another issue is that the UK has accepted an alternative suboptimal solution from Switzerland, which is like the world's largest manager of offshore assets. It manages about 30% of offshore wealth. And that anonymous withholding system, which preserves bank secrecy while just giving the UK cash money, can jeopardize the viability of any global regime to pressure the Swiss, because you actually kind of want the UK involved. They are, at the end of the day, either the most or second most important financial center on earth. And you need everyone to participate to move us into a broad automatic information exchange regime. Creating a uniform, multilateral automatic information exchange system that benefits most countries turns out to require both an efficacious institutional architecture and a very standardized technical architecture. So those two parts, right? And the only way to get there from where we are is for the G20 to use its powers of convocation to establish a governance structure that includes certain key features. Basically, for the automatic information exchange project to succeed as more than just a tool to help the large developed economies address their own domestic offshore tax evasion problems, we will need to see the emergence of, first, a standard setter for automatic information exchange. Second, a monitoring body that verifies compliance with the regime by both governments and financial institutions. Third, enforcement mechanisms with teeth. And finally, technical assistance to help developing countries take advantage of the whole system. So that's 4 not-so-easy pieces. But precedent exists for the creation of such an architecture in the context of things like the Financial Action Task Force addressing money laundering and terrorist finance, and the Basel Committee addressing capital adequacy rules, and the Financial Stability Board. In those areas, you see soft law international institutions that are surprisingly efficacious and that tend to have each of the 4 elements I just described. And indeed, there's a proto-standard setter that already exists for automatic information exchange, including in the coordinating body of the Multilateral Convention on Administrative Assistance in Tax Matters, which is a multilateral treaty that provides an international law basis for automatic information exchange. And there is a proto-monitoring body in something called the Global Forum, which today engages in peer review of countries' ability to meet a lower standard of information exchange, something called information exchange upon request. But to make those green shoots bloom, right, into the efficacious 4-part governance structure that I've described, emerging country governments and civil society and academia need to lobby G20 decision makers to take the next step. One important component of a successful lobbying effort that I want to highlight will be for civil society and emerging countries to recognize that on this issue, they have an improbable ally in many multinational financial institutions. Those institutions have many of the same incentives as emerging countries, at least with respect to the technical architecture. That's because for the big banks and funds, once they are forced to comply by the US, their biggest fear is that they will also be forced to comply by other jurisdictions in similar but not technically identical ways. Multinational financial institutions want to take the lemon that is being forced to be tax agents cross-border and turn it into slightly less bitter lemonade, right? Of saying, look, we'll be those tax agents, but we'll only have to do it in one consistent and commercially reasonable way that makes sense around the world and not just for the Internal Revenue Service. So if you're for the Internal Revenue Service, you don't necessarily love this. But if you're for emerging and developing country tax administrators, you should see that there is room for lobbying partnerships. Another part of the lobbying effort has to be to convince jurisdictions that automatic information exchange to impose some legal measure to encourage participation by other countries and institutions is key, okay? As long as the United States is the only country exercising coercive authority to ensure compliance, then defecting from the emerging regime of automatic information exchange remains possible, indeed relatively easy. Willingness on the part of other countries to exert some coercive sanction, right, to support automatic information exchange is also needed if the United States is going to be encouraged to participate in a truly multilateral system rather than to focus on a version of FATCA that is built just to serve the United States alone. In other words, it has to be that everyone is pressuring the US and other countries too to get the US involved in a multilateral, a truly multilateral approach. So I guess my message here is that right now there is both great opportunity and a real problem as a result of the path dependence in the development of an international tax automatic information exchange regime. The US march towards FATCA implementation is well underway, while the multilateral process is hung up by the European Commission, by the Swiss-UK anonymous withholding deal, and by a series of other obstacles, all of which may become embedded and dictate suboptimal outcomes, both for the small number, the relatively small number of countries that are engaged in the debate, and for the rest of the world. And that could go on for a prolonged period, resulting in effectively a suboptimal system that does address offshore tax evasion, but really benefits only the strongest states. Now that means that the time for a concerted lobbying effort to create a uniform automatic information exchange regime is now, before that fragmented system becomes embedded. And what civil society activists should be pushing for, in my mind, is a global standard setter, a monitoring body that engages of peer review of governments and review of nominated financial institutions. So not every financial institution, because it's just not possible, but nominated financial institutions as well. Enforcement mechanisms that are imposed by governments beyond just the United States, and perhaps most importantly then, from the developing country perspective, a robust technical assistance architecture that makes good on the G20 promise of 2 years ago to work towards a more cooperative international tax environment that benefits less developed countries, and that recognizes that just having information exchanged is not necessarily enough for a variety of less sophisticated tax administrators around the world. If these things happen, to my mind, there is a huge opportunity for emerging and developing economies to get a very substantial fiscal and political and institutional set of benefits out of a new automatic information exchange regime. And with that, I'm done.